Hi everyone, today we will speak about 3 dividend stocks, 3 US stocks to buy right now. For me it's 3 stocks with very low ratios, very low P/E ratios, very cheap stocks, and of course high enough dividend yield. Let's start with the first one. It's Best Buy. Now the stock cost 80 bucks, and its performance year to date, it's minor 20%. As we can see here, it's some kind of support level. So regarding momentum, now it's maybe the very good time, very good opportunity to buy this stock. Best Buy is an American company that owns a large chain of consumer electronics and related products stores. It's a part of Fortune 1000 and the largest consumer electronics retailer in the US and Canada. The company recently cut its financial guidance for the current fiscal years ending January 2023 by about 30%, to an average of 8.70 per share. And if we look at the momentum parameter here, it's 89, so it's a weekly chart. So here now it's close to the lowest borders. Let's check its Best Buy fundamentals. We can see that the total score is 80 points. It's a very high score. Its financial strength, cash to debt, is above 1, debt to EBITDA is only 1, very high interest coverage. It means that the operational income is much bigger, much higher than its the interest company is paying. And also Altman's score is above 3. That it tells us that the probability of default of bankruptcy in the earlier years is not so high. About the profitability, we can see that gross margin 22 and net margin is 4%. It means that company is now profitable. And let's see last years its revenue. Yeah, we see that last 5-6 years it's stable. Also we can see that last 3 years revenue is growth is 10%. EBITDA is also showing growth of 70%. And of course its value, the ratios, we can see that P/E is now less than 10, and P/S ratio, price per share, is also above 1, so we can see it's very cheap stock now. Also regarding the forecasts, we can see that this year and the next one, it will be the revenue will little bit will grow a little bit, the EBITDA will show growth, and the EPS, the earning per share, also will show us a stable growth. And regarding the dividends, we can see that now current dividend yield is 10.7%, and the dividend payout is only 30%. The dividend payout is only 30%. It tells us that the company have the ability to increase the dividend paying. And also the average 3-year dividend growth rate is above 15%. Finally, Best Buy, for me it's a very cheap stock with good value, very high rank, and also very nice dividends. The next stock is Walgreens Boots, WBA. For the current fiscal year ending in August, the company is forecasting earning growth driven by the COVID vaccine and testing. At the same time, analysts predict a slight decrease in the profit next year, but this has already been reflected in the low price of WBA. It seems to me that the impact was too strong, and that the fair price of the share is higher. At the graph, I see that maybe it was the first wave here. It's a weekly chart. Then we have a correctional second wave finished with the COVID decrease. Now I hope it's now growing third wave. So as I see the momentum and the graph, the Elliott waves, from now it's probably a good opportunity to buy. And also the value, the ratios P/E is about 6 P/E. I would like to remind that the average P/E ratio of S&P 500 index is around 20, so it's very cheap stock for now. Let's check the WBA fundamentals. We can see that its total score is 83. It's high enough. Its ratio of debt to EBITDA is 4, interest coverage more than 5, and also the company have a debt to equity ratio of 1/4. Of course, it's not so good as the previous stock. It's not so its financial stability not so high as BestBuy. But we can see the gross margin, the net margin, that still it's a profitable company. The P/E ratio here is only 6, and P/S, price per share, is less than 1. So it's very cheap stock. This company WBA now paying dividend more than 4%. Its payout ratio is less than 30%. The average growth rate of its dividend is around 5%. And the next company is 3M Companies. Of course, it's American Chemical Corporation operating in the fields of industrial, worker safety, healthcare, and FMCG. 3M, it's a diversified industrial company. Is now undervalued due to investors' concern about legal liability issues, including issues related to PFAS chemical compound. According to analysts, environmental obligations have become a fairly serious problem for the companies this year, but that is where the low rating comes from. The stock price is about 150, trading for less than P/E 14. As we can see its graphics, so the P/E, let's check it. Yes, now it's 15 P/E ratio. It's the lowest, I hope, since 2040, 2050, so last 10 years. It's here, this ratio is the lowest one, only 15. It's cheaper than the average S&P 500, and P/S ratio, price per share, also only 2 and 3, also very cheap, very low. Let's have a look for 3M's financials. Its total score is 88. Its debt to EBITDA is below 2. It's have very high interest coverage, and the Altman Z score also above 3, so the probability of bankruptcy is not high. 3M has very high margins. Its gross margin 45. The liquidity ratio, current quick ratio, is more than 1. It's very good, and of course the dividend yield. Yeah, we can see that it's 4%. The payout is only 62%, so the company is able to increase its payout ratio, to increase paying dividends. And we see the total value rank, yeah, of P/E at 15, but forward the future P/E ratio at 13, and the P/E price per share, P/S ratio, it's very cheap, very low, only 2, and below 3. Of course, when we can see such margin and such a low P/S ratio, for me it's a great opportunity to buy the stocks now. So as we can see, all these cheap stocks, profitable companies that pay good dividends, have some difficult at this moment. They are not perfect, but I think that they are safe, and this time very cheap companies, almost never, because the price takes everything into account. Some of the current difficult will turn out to be temporary, and the share price go up again. Some will remain with the companies for a long time, and they will not be allowed to grow. But as for above companies, most likely, no matter what happens, they will be able to maintain their dividend payments. So as for my positions in this company, I hold 3M and WBA. These two companies from the above list, in my opinion, are the most stable. So if you liked this video, subscribe, press likes, and in the future it will be more videos regarding American stocks, American market, S&P and Nasdaq. We will research the companies, technical analysis, its graphics. When it will be the report season, of course, we will check the reports of these companies. So thank you for watching this video, and see you on the next time. Bye.